because
housing market?
multifamily new starts were still strong. That's to say structures with 5 units or more, but because single family starts had really jumped. And again, we're seeing this in the new home sales figures as well. We're also seeing some a return of some strength, or at least a very clear bottoming in at least the month-to-month pricing in the housing market, as represented by the Case-Shiller index as well. So it appeared to me that after about a year and a half, or really a year of some kind of slowdown in general in housing activity and disinflation in home prices, that we're now seeing a floor and then a potential rally.
And I know a lot of people have been waiting for the single-family home market to catch up with the multi-family market there. But talk about the supply of homes, because we did see the supply of homes available fell 0.9%, down 2.9% from last year. So what are we seeing here? At what point are we going to see this level out more?
Yeah, we're certainly seeing, homes listed for sale, right, have come down. But at the same time, we've got a lot of housing under construction. The new housing starts data would tell us that we now have, it's increasing again, close to 1.7 million housing units under construction. That's enough to rebuild every house, every home in Connecticut, and then half of Wyoming. There's a lot of housing under construction today. So we don't really need to look at the existing home sales, the existing houses that are being listed. We can really just see that there's a lot of new product in pipeline, and we're already seeing this start to clear in the increased new home sales.
And as we're in this pausing phase for the Federal Reserve here, then what is that going to do in terms of interest rates and people thinking, is now still a good time to buy? Should I wait and perhaps then refinance if I do buy now?
Yeah, I think that's a question a lot of consumers are asking themselves. It really depends on what's going to happen at the long end of the curve. Our own analysis right now would say that because the Federal Reserve is still engaged in QT, that's to say that it's shrinking its balance sheet, and that some of that shrinkage is coming from the mortgage-backed security space. Not only is the 10-year artificially high, arguably, but even the mortgage spread is pretty wide. So right now, I think people could look to at least the potential benefit that at some point these long-term interest rates might come in a little bit so that they might refinance, but certainly it's a challenge for anybody trying to buy a home today if they have to be using leverage.
And do you think we're at the end of the hiking stage for the Fed?
Yeah, we do. We think, again, the market indicates there could be a possibility of another hike here or there, but I think it's quite clear that if anything, they're more likely to end up cutting over the next year than continuing a bold hiking pattern. My own view would be that continued disinflation just in the CPI index, that's again to say that inflation itself is cooling, could give room for the Fed to create a policy rate that corresponds with the lower inflation rate without us necessarily going into a recession. That's another way of saying we could see rate cuts without us going into a recession.
That's certainly an option. We know that the Fed did leave those options pretty open, being a data-dependent Fed, especially at the moment. A big thank you there to Brad.